Hey guys, welcome back to the Capital Mindset Show. We're going to be talking about DocuSign. DocuSign is down 23.28% as of filming right now. I'll showcase for that right here. So as you can see, it's down 23.28% after going down 3.04% throughout the day. What happened? Well, we saw earnings come out. So earnings were actually at a miss. They actually were expected to have 46 cents in profit. They actually came out with a 38-cent profit. Revenue did grow strongly at about 25.5%, just below what they were expecting at around 26%. Now, what happened, right? Guidance. So guidance has been the key for a lot of these stay-at-home stocks, a lot of these B2B companies. We've been talking about in the past some other B2B companies that would be kind of a showcase as to how well the economy might be doing, because you got to think about it. If businesses are kind of struggling, what are they going to do? They're going to pull back on businesses that they may, or services that they may or may not need, right? They're going to do a judgment call, a valuation strategy. They're going to probably go with the cheaper option maybe. DocuSign for sure is the undisputed leader, and it is another Cathie Wood stock. So as you might say, or as a joke, this company might take you down to the proverbial truck stop, okay? So we actually take a look at that 1 year price. We'll actually show you here. It's down about 64.06%. Over that 5 year, however, it is still up 119.88%. Over that max since its IPO, it is actually, well, actually, I think it's IPO'd, in 2018. So it's still doing well since its IPO, but that's relative, right? So on that note, we're going to actually look at some key aspects or some details regarding the company. I'd say that if you look at this company from the stay-at-home trend, so to speak, it kind of benefited. I want to highlight some two key competitors that we have talked about in the past, one of them being Dropbox. Dropbox owns HelloSign, which is very similar, something that I have a little bit of exposure to. I also have used DocuSign in the past, depending if I'm signing some bank documents. I'll use DocuSign. It's very convenient, that's for sure. But you also have to think about Adobe. Adobe has a competing product, such as Adobe Sign. There are many other variants in competition actually arising from the woodwork, because the barriers to entry isn't that high. You have to consider the stickiness factor of the software. Now, of course, we haven't had, at least that I can think of, a dedicated video to DocuSign. However, so as I was saying, there was no dedicated video to this company. There were some mentions in different live streams, of course, about this company. So DocuSign, it was made in conjunction with the context of HelloSign, Adobe Sign, and the like. Now, here I just wanted to share with you the CNBC, take on DocuSign. So DocuSign is a business that will be impaired in the long-term sense. Triviality is Adam Partner. I don't care. But Adam Partner says that. And what he's kind of saying with that, I want to just give off some commentary on this. I think it depends. So I've been making this case here that the moat is kind of questionable. So what are the costs really to change out of DocuSign? That has yet to be seen. It is a business that was associated with this work from home trend. However, I don't think that's necessarily fair. It's not necessarily going to go away just because people are returning back to the office. I think their technology is very useful in business situations to kind of transmit signed documents, at least even in my experience when I want to, again, send bank paperwork documents and sign them. It's very convenient for me as a user to do so from the comfort of my home and just send them everything I need. Now, with that being said, I actually want to take us over to the evaluation tool, and we're going to see exactly what the heck is going on here. So I already took the liberty of plugging it in, and I'm going to actually move you guys here, and I'm going to make it better visual for those of you who look at it through mobile. So if we actually take a look at the analysts, and I'm actually going to be tweaking this as we go along. By the way, as a friendly reminder, we are very close to actually getting this to the alpha mode, and we're going to be going into alpha testing very soon, but I'll keep you guys updated to that. So if we look at the analyst rankings, they have it at a buy with a price target of $117.14. Again, I'm going to be tweaking that a little bit to actually showcase greater amounts of rankings based off of institutional rankings, so we can see from different analysts. I'm going to have that kind of working, I guess, next week, but shouldn't be too hard for me. And then the price target of $117.14 does imply 34.09% upside. This is after the close. I want to keep you in mind that the today price right there doesn't show the aftermarket price. The aftermarket price is in fact in the 60s. So after tomorrow, it should update to $67.39 if all else being equal, okay? So just keep that in mind as we go through this. And when we actually take a look at DocuSign here, the growth rate, I kind of have it estimated at being anywhere between on the low end, 10, right? 10 on the low end, 10 to 15%. That's the lower estimations, to on the higher estimations, 30 to 35%. So historically, DocuSign has experienced growth rates in between 50, and I just said 50, 50 and 45%. That has been, again, its historical growth. You might actually point to the fact that, and if you can actually go down here and actually take a look at that trend line, very strong trend line growth. But you can point to the fact that we had the pandemic. A lot of people kind of were pushed. A lot of companies were pushed to kind of adopt this technology than before. You actually take a look at that estimates in sales. This is what was a kind of a shock to the system, and I'm going to highlight to you here. If you look at that average estimates, they were expecting growth rates to kind of push up even further into the year, and they're coming out and lowering their guidance. Again, if we actually look at it from the context of the liquidity crunch that we've been talking about for quite some time, it kind of makes sense. It all kind of adds together into giving you kind of further context as to understanding what the heck is going on. Was this kind of something that was predictable? Of course, we have talked about this company in the past from the context that it is kind of expensive. And of course, there are many other creators who have also been saying the same thing. So this is not something that should have been out of nowhere. Cathie Wood, she's not really known for picking companies that are probably priced appropriately, to say the least. And remember, she's been through this rodeo before. We've talked about her in the past before. Definitely not going to get an offer from ARK Invest by any stretch of the imagination at any point in the future. Of course, Cathie, if you're listening, you know, there is a price. There is a price. Now, if we take a look at the cash flows, estimates are actually coming down on that same time period. Of course, that could be because of predictions for R&D expenditure to increase. That could be the case. And so we would expect greater investment. Now, shares outstanding, this is a net diluter. So I'm not even factoring that right now, but we're going to factor that later. If we actually take a look over to the ratios, we are going to see some good liquidity ratios here, or pretty strong liquidity ratios for the most part, except more recently that current ratio actually dipped below 1. We look at the solvency ratios. Things are actually deteriorating in some cases. This is a company that used to have no debt whatsoever. Now it does seem to have some sort of debt. Financial leverage, interest coverage doesn't seem to be getting better, getting worse, so they are taking on more leverage. The DuPont analysis does indicate very strong margins, very strong. Well, operating margins, of course, they're not so good right now, but the company should kind of improve those as it goes along, as it matures. If we actually take a look at the earnings quality, it is improving drastically. We had a 2019-2020 underperformance on that measure, but remember, it's correlation, not causation. We've talked about this in the past when we kind of map out the ranking there along with stock price, and then the free cash flow margin is growing nicely. So I do like to see that there. So with that being said, I'm going to take us over to the financial statements on this report. All right, so taking us over to the financial statements, we're here on the 8K. So right here we can kind of see cash and cash equivalents actually growing there, and investments in current assets actually growing there as well. We actually take it down to the liability section. I want to actually try to find where they have that long-term debt that we were seeing. Again, we could actually see that debt measure coming out from other things. So we have contract liabilities, operating lease liabilities. Okay, so that's a form of debt. Total liabilities, deferred tax, convertible senior notes. Okay, so they have some debt there. So in totality, they have some debt, but it's manageable relative to the size of the amount of assets they have, or current assets they have. So nothing crazy. Definitely on the current assets versus current liabilities, they are well covered. I think that all in all, there are a lot of qualitative aspects to this company that I do like. If we actually take a look at that business revenue section, we do see that subscription revenues make up the bulk of these revenues. And so this kind of gives us a bit of predictability, makes it I would say analysts will have an easier time making predictions into the future. However, they're kind of blindsided by this guidance here. And again, that's why the stock price is reacting so strongly. And this kind of reminds us to a previous video I made where I said, if you know, or if you don't have much of a margin of safety on a company, you must know everything about that company like the back of your hand, because everything has to go right in order for the investment to go right for yourself. So from that, let's actually go over to the statement of cash flows, and we're actually going to look at the cash provided by operating activities. Okay, so that's rising nicely. If we actually take a look at on a GAAP net income basis, they are actually still negative. Okay, we want to take a look at the stock-based compensation. they are actually increasing that stock-based compensation. That's not necessarily a negative. However, the size of that kind of does indicate the only reason why they're cash flow positive, and you can see that definitely with that $110 million figure and that $196 million in cash flows from operations. The only reason why they are cash flow positive is because they are expensing a tremendous amount of those costs through stock-based compensation. So in kind of a philosophical sense, who is paying for that? Well, the person who's paying for that is you, the shareholder. So you have to kind of account for that. We're going to account for that in our evaluation. So when we actually get to that, we're going to kind of I wouldn't go as crazy, but we are going to get pretty punishing here. So about a -4% evaluation. And so what I want to highlight, we're actually not using the current numbers today. We're using the previous numbers. And we're going to basically see what the model would tell us prior to today's earnings report, which is, again, why I'm kind of filming this off the cuff here, because I want to get this out there to show everyone what would the model say if I was recording this before the earnings, because this is technically still before pre-earnings numbers, as they haven't posted yet. And we're going to see, would the model have recommended us to enter a position here? Now, we're going to kind of lower our margin of safety for whatever reason, but just why not? And we're going to see that on the higher end of the measure, we do see that well, that's not technically the highest end. We want to actually put that in the middle. And I said 15 and 10 on the lower end of the spectrum, and then 30 and 35 would be on the higher ends of the spectrum. So you can see that at this lower margin of safety, we are actually entering on that midpoint probability. That I think it's, yeah, very close to that price. So today, now it's at $67.30 after hours. And here today, it was actually saying the fair value or the buy price would have been $69.98. So if you believe that these were the scenarios that in place, that would be the entry price. So it was clearly overvalued. And if, you know, forget about it if you were talking about it over here when it was $200 a share, right? This would not have been a good entry point according to the model. Now, if we actually increase our margin of safety, or our necessary margin of safety, to about 15-ish%, we will actually see that the price today would imply that we would have to expect a 30% growth. So faster growth than what we actually got. We got 25% growth here today. And again, they would have to maintain that. So, you know, I think still the company's not giving us a good entry point, in my personal opinion. We also have to consider, again, that dilution factor. I'm kind of being a little bit generous with the dilution factor. It's probably going to be a little bit more egregious on that front. Now, if you want the greatest margin of safety, or not the greatest, but a greater margin of safety, you can kind of see what the prices would indicate there. So on all in all, what I'm kind of seeing from this company is, while it has some strong qualitative aspects to it, like, for example, it's not really at risk of bankruptcy by any stretch of the imagination, and it is, quote unquote, fast growing. It may have a sticky business in the sense that it might cost them, you know, a headache to kind of transfer to a competing product. All that doesn't really escape the fact that based off of the valuations today, it doesn't offer a compelling entry point. And again, I don't know what the great Cathie Wood was actually seeing in the company, or what she thought of the company. But more overtly, again, we're kind of using older numbers. And again, the model is saying, no, not a good buy. So that's the reason why we're filming it on 6/9/2022. I know that the numbers have come out and we have seen the stock price come down, but just reiterating that this is actually using pre-updated numbers, and it's saying that no, thank you. So it even would say so even if they beat the growth rate that they had at about, you know, they had a 25% growth rate. If we assume accelerating growth rates, it still wouldn't be a good entry point. Because let me reiterate that if we get back to that 15%. Okay, we'd have to assume a 35% growth rate, which would be quite a bit of an acceleration from what they actually reported here today. On that note, guys, I think that kind of summarizes this company. And if you guys enjoyed this video, feel free to leave a like. If you're not subscribed, go ahead and subscribe. By the way, if you guys are curious as to what other stocks we have talked about in the past, I'll go ahead and share this with you. It should be in the description down below. It is a content library. You go on there, you can come on here and you press Control F, type in the ticker symbol. So for example, let's say you want to see, have I talked about Alibaba. You just do Baba. It's not case sensitive, and it will show you all the videos by the date that I have done them on that stock. So the vast majority of videos should be included. I think some of the newer videos are not in here yet, but I'm going to put them in there. And you can kind of scroll through this. You don't have to use the search function, but it does help to kind of scroll through these companies. And over time, of course, Capital Mindset will have a massive content library where users can actually go back and see all of the different thoughts expressed in the past. And so where have things changed? How have things aged? And has it been useful? Okay, so on that note, thank you guys so much for watching, and I'll see you on the next one. Bye.